What's going on, everybody? It's a pleasure to be back here on the pod with all of you. It's been really cool to start to meet some of the people who listen to this in person. I held a dinner in New York City for 20, 25 CFOs. We had 31 total people in the room. It absolutely blew my mind. And I get really nervous before these events, just thinking the worst that nobody's going to show up. I'm going to be sitting in a room by myself, but I'll also somehow say something stupid and offend somebody or just, I don't know. I go through all the motions of like why this won't work. And then, of course, it was like a huge success, a lot of great energy in the room. And funny story. So I have to travel every once in a while for these dinners and for work and whatnot. And my 3-year-old, she thinks it's fascinating that I travel. Like, oh, daddy goes on an airplane. And her biggest fear is that I'm going to get there and not have any toys to play with. And so I got a great surprise when I got to the hotel and I cracked open my bag. There was a Kobe Bryant bobblehead that she went up to my office and took it and stuffed it in my bag. Very thoughtful because she wanted me to have toys when I got to my location. So shout out to my daughter. You're the real hero. I want to go through the state of the private markets. We do this once a month where we deliver the most compelling valuation, hiring, and revenue insights on pre IPO candidates. So you can think of this as your backstage pass to the companies that are shaping the future before they go and hit that public market. What we'll start with today, and for those of you who are watching the video version of this, it's pretty crazy. Half of our views now are coming from YouTube. Like, I'm glad I'm leaning into the video part of this because I'm actually more of an audio person. I listen to all my podcasts, but I don't usually do the video. But hey, people dig the video. So we're gonna do that from time to time, where I'll also do a screen share so you can see my ugly mug, but most importantly, some of the metrics here. But let's go through the scoreboard of the most valuable private tech companies. And so I partnered up with my buddies over at position.so to track some of these valuation rankings, as well as the headcount changes and some other data points across 5,000 private companies. So number one is SpaceX. They're coming at 350 billion. Number two is OpenAI, coming in at 300 billion. Number three is ByteDance, TikTok, coming at 253 billion. Stripe is now valued at 91.5 billion after the latest tender, which we did cover last month. XAI is 80 billion, and they have a merger going on there with X, the artist formerly known as Twitter, so they can share resources. Databricks, 62 billion, and that's a higher mark than what Snowflake, their closest competitor, is trading at. If you were to look at their enterprise value in the public markets, Anthropic, 61.5 billion they raised this past month, and to round it out, Revolut, 48 billion. So we just went through the top 10 there and some commentary that you should take away. So OpenAI this month officially joined the 300 billion valuation club, which cements its status as not only one of the most valuable private tech companies, but just tech companies on the planet. And so that's approximately 2 times the current enterprise value of publicly traded Adobe. And it's a 245% jump in the past year in valuation. And it's proof that foundational models are foundational to investor optimism too. Dad joke. Seriously though, I remember standing on a street corner after a happy hour with 2 CFOs last year, and we were like, OpenAI is having a secondary at 150 billion bucks. And we were like, is this the top? Are we top ticking here? Is that what the term is? Top tick? Call the top. And I think we're all looking around like, that's like absolutely bonkers valuation. Now it's more than twice what it was when we were standing on that street corner waiting for our Ubers. Meanwhile, XAI, Elon's AI moonshot, it did seemingly come out of nowhere within the last 12 months. And they've leapt nearly 2,000 spots in the valuation rankings to debut at number 7 here with that $80 billion valuation I mentioned. And whether it's real traction or just like this Tesla style aura, investors are clearly betting big. I have no idea what their revenue numbers are, but there's a combination play with the social media network X going on behind the scenes. I think they were sharing like a CFO and a bunch of other resources. And like, I think it's TBD on how shareholders of XAI take that one, because if you combine the two, they got to kind of think like, well, actually, you're bringing in an asset that like maybe is better separate and may dilute the shares that we have in terms of value. So weird one going on there. What I want to talk about next is SSI Inc., an enigma of a company. They have no revenue and a team that could ostensibly fit in the back of a Yukon Denali. And they now sit at a staggering 32 billion. So in this market, narrative can still outpace fundamentals. We're going to do a deeper dive on them. And then Scale AI continues to defy gravity. So a company with a services heavy model, it's $25 billion valuation and 242% year-over-year growth, up 107 spots in valuation, show that the market is willing to treat infra and outsourcing as one and the same if the margins are right. And not every story was up and to the right. So X, formerly Twitter, it did fall 8 spots in the valuation rankings year over year with a 27% drop in. And we can tell because there are a number of public funds that hold them, like a Fidelity, and you can dig in there to check. And questions around their monetization continue to linger. And then Flipkart, we also saw them go down 4 places with growth seemingly plateauing. And then there's Stripe, right? You know, the quiet giant there holding its ground at number 6. Number 6, highest valued private company in the tech space in the world, still worth $91.5 billion, which is up a respectable 41% year over year and near what they hit in terms of value during COVID, right? I think it was $95 billion. So in a sea of volatility, that says something. We're going to dig into a lot of those companies that I just mentioned and go through what's driving that valuation and their revenue estimates in a second here. But first, I want to talk about headcount, because when it comes to tech businesses, the people are the biggest investment. Like, both the beauty and the horror of a tech business is that your most valuable asset can walk out the door and leave at the end of each night. Like, inventory sucks to have in your balance sheet, but like, it doesn't get sick, it doesn't go on vacation. So yeah, that's why we play the game. And over 70% of SaaS expenses go to headcount. So I look at headcount as a leading indicator of future revenue growth or contraction. And so the fastest hiring companies. So we filtered for companies with more than 500 total employees, so at least 500 butts in seats, who have also raised more than 500 million in capital. And these were the logos that increased total headcount at the fastest rate year on year. We've talked enough about xAI. I mean, they've grown their headcount over, my goodness, like a bazillion percent. Want to look at Vanta? They've grown by 75%. Anduril, 74%, and Tenstorrent, which I can't pronounce, 71%, all clocking in major growth, each adding hundreds of new roles. And we can also see how many open roles there are. So it's not only how many more butts did you put in seats, but are you still aggressively leaning forward and have those recs? And Anduril is also leading in open roles with 804 positions live. So for a defense tech company, in my opinion, it signals both government momentum and investor patience. So they've got some huge contracts in the pipeline if they're still hiring at that pace. Scale AI, which just made waves in the valuation rankings, is also scaling people, because remember, they need people to help train these models and look at all the different images going in. They've had 47% headcount growth year over year. They have more than 4,600 employees with 312 open roles. So despite their services DNA, right, you got to throw more people at the problem, they're staffing like a product first org. Some other notable additions: remote distributed work is alive and well, just maybe less buzzy than last year, but they're still growing at over 50% year on year. Deal and DBT Labs, they're pacing the middle of the chart with solid hiring curves and strong capital positions to back it. And yes, The Boring Company. My wife got me a hat because she said I was boring. It was like an inside joke. Thank you. They're hiring too, albeit modestly. 537 total employees, smallest to make the cut on this list because we filtered 500 more, but it's still a real company, not just a flamethrower gimmick, with over 1 billion raised. So tunnels to be had. Sharpest decreases to headcount. So who are the companies that are pulling back most aggressively? So brands like Harry's, Noom, and BitSight are quietly trimming staff as growth gives way to margin discipline. And then with over 21,000 employees and only one open job posting, come and get it while it's hot. Byju's isn't just slowing hiring, it's in a full hiring freeze. So if you look here, Harry's Inc. decrease of 27% in headcount year over year. Northvolt decrease of 23% year over year. Byju's decrease of 19%. Sysdig decrease of 15% headcount. Sierra Space down 10.5%. Klarna, who was going to IPO but now hit pause, down 10%. They're saying AI efficiencies. Getter delivering watermelons and water on bicycles, minus 10%. All right. Sector-specific highlights. Let's check in on data and infra. Quietly powering the AI boom. So the companies that I'm checking on here: Databricks, Fivetran, DBT Labs, Dataiku. I hope that's how you pronounce it. Sounds like haiku. I love a good poem. Dreamio, Cloudera, Airbyte, DataRobot, and Census. So Databricks is a clear giant. 62 billion, over 10,000 employees, Like I said, trading at a higher valuation in private markets than Snowflake in the public sphere. And now with Mosaic ML under its belt, it's a de facto AI infra layer for the enterprise. So they're riding this AI wave maybe like no other. DBT Labs, they're growing fast, 47% headcount growth and a 4.2 billion valuation. So Transform is no longer the middle child in the ELT flow. And I have blown through a couple of monthly budgets on DBT Labs, which was actually a good thing because we had a data product, which meant that more people were using what we were building. So our cost of goods sold went up, but our revenue was also going up at the time. So you can build on top of it. It's a transformational product if you do it right. And I have an interview with their CFO coming out soon. Fivetran, they're keeping things efficient with a fresh 125 million in funding and a steady climb, while Census seems to be in a bit of reset mode. They trimmed their headcount, but they're holding on to a $630 million valuation. So what's the takeaway from this? Why should we care? I think it's because the data layer isn't going anywhere. It's just getting more disciplined, more embedded, and more essential, right? You're not just going to rip out like a Databricks overnight. It's pretty sticky. I want to check in on the design sector. So the likes of Canva, Miro, Figma, InVision. And they're still trying to find their post-Zoom era footing. Like design, that sector went absolutely bonkers during COVID because everyone was working from home and sharing all the, projects that they were working on. I had a great dinner with Justin, CFO of Miro in New York City at that event that I was talking about. And I was telling him like, hey man, like everyone in our company was using Miro, even like our head of corp dev, he made like, I picture the meme of Charlie from It's Always Sunny with like the crime scene investigation and like the strings and the pictures of like, of tracing who was where. He was like mapping out the hierarchy within these large organizations of like who is responsible for what budget. And it was actually impressive. And you can see how there are infinite use cases for these tools if done right. So Canva is still leading the pack, 32 billion valuation, but it's down 20% from its peak, right? Modest headcount growth. I was really surprised by this one. Only 3.7% year-over-year headcount growth, suggesting they're focusing on efficiency over expansion. And they are making that play to sell less B2C and more B2B, particularly in the enterprise. Figma, they're riding a post-Adobe breakup bounce, 12.5 billion valuation, which is plus 25% and nearly 20% headcount growth year on year. And they've stayed sticky even without that 20 billion buyout. So remember, Adobe tried to buy them for 20 billion, but it got blocked by the Federal Trade Commission, and they have confidently filed for an IPO. I said confidently. I guess they are confident if they're doing it in this macro environment. I meant confidentially. They confidently filed for an IPO that would value them close to the failed M&A mark. So expect them to get at least a $20 billion valuation. They've fully grown into it, which is like awesome to see. It wasn't just a story of where you get this valuation that you'll never reach. So great job by them. I think they have over $1 billion in ARR now. Miro's 400 million round shows that there's still appetite for visual collaboration if you're entrenched in the workflow, and they've clearly pulled away from InVision. In fact, they acquired some of their assets in 2023. Good job by them. Category isn't dead, but I mean, the bar is higher. To keep growing, these tools have to prove they're essential beyond product and design teams, right? Can other teams use them? And will they replace board decks? Who knows? Bum, bum, bum. Direct to consumer, D2C, baby. Row, Aura, Whoop, Farmer's Dog. I love the Farmer's Dog. Harry's Inc., Glossier, Brooklinen. You hear them on like every podcast except mine. 8 Sleep. Friend of the pod, Nicholas Chamas. Magic Spoon. So the D2C crowd is back in growth mode, but only if you've nailed margins and you've moved beyond one-hit SKUs, right? Like you don't want to just be a one-hit wonder with only one product. And so Rose leading the charge, $7 billion valuation. I was really surprised by that one. 22% headcount growth and another 150 million raised. And they're proof that vertical health plays still a scale if you can manage both prescription and logistics. So like vertical integration here with D2C is core. Aura, Whoop, 8 Sleep, they're riding the wellness wave. Got to be healthy, right? I've taken a couple multivitamins today. Each saw 25 to 33% team growth with valuation momentum to match. And the quantified self movement is alive and investor backed. I was actually thinking about getting an Aura ring and replacing my wedding ring with that. I don't know. TBD. Farmer's Dog is now worth 2.7 billion and recently exceeded the 1 billion revenue mark. That's slinging a lot of dog food. Walter, our editor in chief, loves it. Pet spending is proving recession resistant. You're not going to be like, hey, I'm not feeding my dog anymore. Trade war. No, it's what I feed our editor. Like I said, other than ice cream, which I've told them they should expand into multiple times. I've seriously written them and said, why aren't you selling pup cups? It seems like you should ride that S-curve. If someone from their product team, Farmer's Dog product team, if you're reading, listening, we'd be happy to promote you for the right price, of course. On the flip side, Harry's saw a 23% headcount drop, as we mentioned, likely right-sizing after ambitious omni-channel expansion. It's hard to get that right. And Glossier, meanwhile, looks to be holding steady after its own recent reset. So the bottom line here, DTC brands now look more like full-stack platforms and single-product shops. I think that's the evolution you got to make here if you want to be durable. And those are the ones investors are still betting on. There's still investment going into DTC brands if they're in the right price. Let's talk about Scale AI here. If AI is oil, Scale AI is the oil refinery. I always think about that scene from Joe Dirt when he's like, I'm new, I don't know what to do. And the oil is going everywhere. And Scale AI, they aren't afraid to get messy. So secondary tender was recently valued at $25 billion, and they're really having a moment. So the company is reportedly on track to hit $2.7 billion in revenue this year. It is now shopping shares at that $25 billion mark through a tender offer. And that's not bad for a startup that started out labeling CapEx. Yeah. And so led by Alexander Wang, Scale has morphed into something much more strategic, a core vendor for anyone trying to train serious AI models. So they're working with the likes of OpenAI, Microsoft, and even the U.S. Department of Defense, helping deploy AI agents that can literally make battlefield decisions. Boom, shakalaka. And they've raised over $1.6 billion with backers like Accel, NVIDIA, Amazon, and Meta all on board. And while they came up a little short, they said, hey, when they raised their last round, we're going to hit $1 billion in revenue. They came up a bit short, I think like $150 million short. But like they've clearly course corrected, and like I'm a recovering FP&A leader. It's really damn hard to forecast anything that's growing at warp speed like that. So they should hit 2.7 billion, which is wild. But it hasn't been all sunshine and neural nets here, folks. Scale is currently under scrutiny from the U.S. Department of Labor, and they're facing lawsuits over wage classification and pay practices for contract workers. Because remember, not all of them are employees technically. They're contract workers, probably paid hourly. And it's a reminder that rapid scaling sometimes outpaces internal ops. And I was getting some Uber vibes here, right? Like break rules, some labor mismanagement claims. They seem to be expanding, I'll say, rather aggressively. But if data is the new oil, Scale's running in the refinery, and they're building a moat around the messy, unglamorous work of structuring the world's data. It ain't much, but it's honest work. SSI, Safe Super Intelligence, the modern day Bell Labs, or is this just an expensive group project? So Safe Super Intelligence Inc. is maybe the most paradoxical name on the leaderboard here. So it was founded in mid-2024 by Ilya Sutskever, the ex-OpenAI co-founder. Remember there was that revolt internally, and then Altman just came back like, nah, dog, I'm the boss. Daniel Gross, ex-Apple AI, and Daniel Levy, ex-Meta. And the company rocketed to a $32 billion valuation without shipping a product or booking a single dollar of revenue. So their mission is to build a safe artificial general intelligence, AGI, emphasis on the safe. It's part of a deliberate scale and peace strategy that favors focus over fanfare. And so the goal isn't to commercialize fast, it's to ensure AI doesn't run off the rails before it gets built. And despite being stealthy, SSI's backers are anything but quiet. NVIDIA, Alphabet, and Green Oaks led a $2 billion round, betting that deep research in a tight team, barely enough to run a pickup basketball game, honestly, can still move AGI ball forward. Me and my brother, Tyler, were laughing about this. Imagine raising $2 billion, you get 7 people in a garage. Like, what do you want to do? You want to, I don't know, maybe order pizza and a couple million chips? I don't know. What do you do with all that? They're running dual headquarters in Palo Alto and Tel Aviv. And with Ilya's departure from OpenAI last year, centered on safety concerns, he's like, hey, this isn't cool. SSI is clearly taking a principled, if high-risk approach. So Bell Labs, if you remember all the really smart people that came out of there, they were just working on all these skunk work projects. I don't know if it's going to be that or a well-funded science experiment. Remains to be seen. And my dog clearly thinks that it's just a science experiment. But I mean, with that kind of valuation, that kind of brain trust, the market is listening. Revolut, from FX to full fintech domination. Like, I just keep taking my eye off the ball here with their valuation, $48 billion in the last secondary tender. So they evolved from a currency exchange app. I was actually using it back then. I remember back in 2020, I was at a company that was using it, and it was mainly just like, let's transfer from one currency to another because we had people in the UK and in Israel. So we had to get US dollars to pounds and shekels. And they're like a financial super app now. And its recent numbers are turning heads. So in 2024, the company reported a 1.1 billion pre-tax profit, and that's in euros, a 149% increase from the previous year on revenues of 3.1 billion euros, a 72% jump. That's really, really profitable and also a ton of revenue. And their growth was fueled by a surge in crypto trading, interest income, and card fees. All that stuff that they didn't do back when I used them. So, wow. So the company's customer base expanded to 52.5 million. That's a ton of people, up from 38 million in 2023. And its workforce grew to over 10,000 employees. CEO and co-founder Nikolai Staronsky increased his stake to more than 25% following a corporate restructuring. Get yours, brother. Revolut finally secured a UK banking license in July 2024 after a 3-year wait. It takes a while to get one of those, allowing it to offer credit products like personal loans and overdrafts. And the company aims to start its UK banking operations in 2025. But you got to wonder, like, not to put my tinfoil hat on here, like, is the US next? Is that the next move? It's got to be. They got 52.5 million users. That's a huge number. So just for context, I think the US population is like 325 million. So 52.5 million users. And I got to imagine a ton of them are in Europe. Like if you want to keep expanding your TAM, you got to go to other geographic areas. So despite its success, they have faced some scrutiny over internal practices. Company implemented a points-based karma system. Ooh, big brother. Ooh, to track employee behavior and compliance, influencing bonus payouts. This initiative aims to foster a healthier work culture and address past criticism. With a valuation of 48 billion, Revolut stands as Europe's most valuable fintech, rivaling major banks like Deutsche and Barclays. I think they're valued higher than those two banks. Some fundraising rounds of note, just like in the past month here. So these were ones that were announced in April. So what's wild is the checkbooks are open again with all the crazy macro stuff going on in the public markets. April saw this massive surge in late stage funding rounds, which signaled that while IPOs remain scarce, private capital is flowing, especially if you're building something AI adjacent or infra heavy. So I'm just going to call out the ones that stood out. So Anthropic led the charge with a 3.5 billion Series E, now valued at a whopping 61.5 billion. But not to be outdone, OpenAI did, of course, say, hold my beer and rally the troops at 300 billion. Neuralink and Neuro pulled in 500 million and 2.2 billion respectively, with 8.5 billion valuations. And if it moves or thinks, it's getting funded these days. Sandbox AQ, ChainGuard, Celestial AI, and together all raised sizable rounds in April with valuations between 2.5 billion and 5.7 billion. That range is heating up. Infra is hot again. And if you pair with machine learning, that's like peanut butter and jelly. Harvey and Runway hit identical 3 billion valuations, showing there's room for both legal AI co-pilots and generative video platforms and investor decks. And remember, these companies are like the fastest to 40, 50, 60 million we've seen in a very long time. Mercury, Series C, 3.5 billion. Congrats to them. Supabase, I think that's a Nicki Minaj song. Series D, 2 billion. Continue to scale the modern backend for startups. Fintech, infra, and dev tools are alive and well. They have been for a while. Tailscale, Temporal, and Replit each locked in fresh capital while doubling down on developer-first ecosystems. And Adam Newman's Flow, $2.5 billion Series B valuation is taking more money. So no word yet if they're cash flow positive on a community-adjusted EBITDA basis or not. But well, that wraps up our latest edition of State of the Private Markets. Stay tuned for next month's deep dive into the companies that are redefining the private markets. And thanks for rocking with me, folks. I really enjoy this.